That 401k you've been diligently contributing to? The one your employer probably called free money? Let's be honest, it feels more like a financial time bomb, and the fuse is already lit. You've been sold this idea that it's your golden ticket to a comfortable retirement. But what the brochure doesn't tell you is that hidden fees are quietly devouring your future. You're far more exposed to a market crash than you realize, and Uncle Sam is waiting at the finish line to take a much bigger piece of your pie than you ever bargained for. Let's get real for a second. There is a massive retirement crisis brewing. Americans now believe they need around $1.26 million to retire comfortably. Yet the average 401k balance sits at just $134,128. That's not a gap. It's a canyon. For workers getting close to retirement, those between 55 and 64, the median 401k balance is a shocking $95,642. And it gets worse. A recent AARP survey found that 1 in 5 Americans over 50 has zero retirement savings at all. The system isn't just broken. It feels like it was designed to benefit Wall Street, not Main Street. They've sold you a dream, but the reality is a nightmare of fine print and hidden dangers. In this video, we're going to expose the 3 ticking time bombs that could make your 401k worthless. And stick around because at the end, we'll talk about how you can actually start taking back control. The first ticking time bomb in your 401k is the one you probably never see: the fees. Sure, the company match feels like free money, but have you ever stopped to ask what that free money is actually costing you? Your 401k is a product, and like any product, it comes with a price tag. A lot of them, actually. You've got administrative fees, investment fees, service fees, and something called 12B1 fees, which are basically just marketing costs. These aren't neatly listed on your statement. They're skimmed directly from your investment returns, silently, year after year. It's like a parasite slowly draining the life from your retirement account. You might be thinking, a small percentage can't hurt. That's exactly what they want you to believe. Average 401k plan fees can range from 0.5% to over 2% annually. Now let's be generous and say your all-in fees are just 1%. Sounds tiny, right? Wrong. The Department of Labor provides a jaw-dropping example. Let's say you're 30 with a $25,000 balance. With 35 years to go and a 7% average return, a low 0.5% fee would leave you with about $227,000. But if your fees are 1.5%, just 1% higher, that final balance drops to only $163,000. That single percentage point just cost you $64,000. Over a 35-year career, a 1% difference in fees can slash your final balance by a staggering 28%. Let that sink in. You could lose almost a third of your nest egg, not to a market crash, but to the fine print. And that's a modest example. For a saver with a larger balance, a 1% fee can cost them hundreds of thousands of dollars over their career. This isn't an accident, it's by design. The system is engineered to make Wall Street rich by siphoning off your money, whether your account goes up or down. But the real kicker is the illusion of choice. Your plan might offer a dozen mutual funds, but many are actively managed funds with notoriously high costs that rarely beat their cheaper, passive index fund cousins in the long run. You're handed a menu of overpriced options, creating paralysis by analysis, where almost any choice you make benefits them more than you. The house always wins. The real question is, how much of your retirement are you willing to give them? The second reason your 401k could be worthless is the catastrophic risk no one talks about until it's too late. Your 401k is not a savings account. Let me say that again. It is not a savings account. It's an investment, and your money is strapped to the stock market roller coaster without a seatbelt. We're all told to set it and forget it and trust the market. And sure, history shows markets trend upward over time, but that's cold comfort for someone about to retire just as the market tanks. Remember 2008? People watched in horror as their life savings were cut in half. More recently, during the 2022 market downturn, the average 401k balance dropped by around 20%. This is called sequence of returns risk. It doesn't matter if the market recovers later. If you're forced to start withdrawing money during a downturn, you lock in those losses forever. Selling your assets when they're down 30% means you have to sell more of them to get the cash you need, permanently crippling your portfolio's ability to bounce back. And who's in control of this market? Not you. You have no say when the next crisis hits or when some algorithm goes haywire. Your money is locked away in a system where you have virtually no control. You can't just pull your money out when you sense trouble without getting hit with massive penalties. You're forced to ride the wave, even if it's heading straight for the rocks. This is especially dangerous because so many are already behind. For those nearing retirement, a 20% market drop isn't a setback. It's a catastrophe. It could mean the difference between a dignified retirement and greeting shoppers at a big box store in your 70s. The buy and hold story works great for financial institutions collecting their fees no matter what. For the average person, though, it's a huge gamble. You're betting decades of your life's work on the hope that the market won't crash at the worst possible moment. In today's volatile and interconnected world, that bet looks riskier every single day. The third and final bomb is the most insidious because it's disguised as the 401k's biggest selling point: tax deferral. You've been sold the idea that putting money into a traditional 401k is a brilliant move because you lower your taxable income today. It feels like you're getting one over on the government, but what you're really doing is not avoiding taxes, but postponing them. You're basically entering into a partnership with the government on your life savings, and you're letting them set the terms of that deal decades from now. Ask yourself one critical question. Do you really think tax rates will be lower in the future? With a national debt spiraling into the tens of trillions and entitlement programs under strain, where do you think the government will look for money? Those trillions locked away in 401ks and IRAs are a very tempting target. Deferring your taxes is like scheduling a financial reckoning for a future date. You're trading a known tax rate today for a completely unknown and likely much higher tax rate in retirement. Withdrawals from a traditional 401k are taxed as ordinary income, which can be much higher than long-term capital gains rates. Your disciplined saving could ironically push you into a higher tax bracket right when you need the money most. It gets even worse. You don't even have full control over when you pay these taxes. Once you turn 73, the government forces you to start taking money out through required minimum distributions, or RMDs. It doesn't matter if the market just crashed. It doesn't matter if you don't need the cash. The IRS wants its cut, and you will be forced to sell assets and pay up, regardless of the consequences. This tax trap turns your retirement account into a golden goose for the IRS. You took all the risk for 40 years. You paid the fees. You weathered the crashes. And just when you're ready to collect your reward, you find out your partner, the government, has changed the rules and is demanding a bigger share than you ever anticipated. So your 401k is being eaten by fees. It's totally exposed to market crashes, and it's a tax time bomb. Sounds pretty hopeless, right? But it's not. The point of this isn't to scare you into hiding your money under the mattress. It's to wake you up. The problem with the 401k is that it breeds dependency. It teaches you to hand over your money and control to giant institutions and just hope for the best. The solution is to reject that dependency and start taking charge of your own financial destiny. This means prioritizing your own financial education. It means learning about assets that Wall Street can't skim fees from.
Business.
Assets you actually own and control. Things like investment real estate that generates cash flow, starting a business, or using a self-directed IRA to buy alternative assets like precious metals or private equity. The key isn't one specific product. It's a complete mindset shift. It's moving from being a passive saver to an active, informed investor. It's about building a financial fortress around your wealth, instead of just handing it over to someone else. Stop blindly trusting a system that wasn't built for you. If this video opened your eyes and you're ready to start taking back control, then do yourself a favor. Hit that subscribe button and ring the notification bell. We're going to be exploring the strategies and assets that can help you build real, lasting wealth outside of this broken system. And now I want to hear from you. Drop a comment below with your biggest frustration about your 401k. Is it the fees, the market risk, or the tax man? Let's start a real conversation about it. The 401k was sold to us as the key to a secure retirement. But for millions, it's becoming clear it's a deeply flawed vehicle. It's a system where hidden fees silently gut your savings, where your life's work is vulnerable to devastating market swings you can't control, and where the tax benefits are just a trap waiting to spring when you're most vulnerable. Don't wait until it's too late. Don't wake up at 65 to discover your nest egg is a fraction of what you were promised. Start questioning the conventional wisdom. Start learning what the wealthy have always known. True financial security doesn't come from handing your money to someone else. It comes from taking control. Thanks for watching.